Good morning, ladies and gentlemen. My name is Simon Taylor. Welcome to episode 87 of the FinTech Insider Breakfast Show. In this show, we bring you the best and brightest from around the fintech and banking landscape every single weekday straight to your homes at 8:30 British summertime, apart from on Wednesdays when Sam Moore goes live at 3:30 British summertime or 10:30 Eastern time for our US friends. Both shows go live here on LinkedIn. Today, I am thrilled to be joined by Uma Rajah, who is co-founder and CEO of CapitalRise. On today's show, we're going to take a look at the alternative lending in the prime property market and how that market has opened up to individual investors. I'm excited to get into this one. Huge market, exciting space to be. But first up, Uma, how's it going?
Good, thank you. Enjoying the rather strange setup that we have nowadays with the lockdown, but all good, thank you.
It is. It's a strange setup, but it's a setup that allows our audience to ask questions. So if you are watching, do remember to send those questions on the comment sections, and we'll get them to Uma, and we'll make sure we're getting those in. But Uma, tell me your story. What's your background?
Yeah, so I guess my journey to the fintech world is rather strange. I graduated a long time ago as an engineer. I studied engineering at Cambridge for my sins, and I went into industry because I studied manufacturing industry, and I spent the first decade of my career in fast-moving consumer goods, particularly in the kind of product innovation space, and that's really where I guess I developed this love for understanding kind of how you translate what consumers want into brand new products, albeit in a very different sphere to the sphere I'm now in. After about 10 years there, I then did my MBA at INSEAD, and then I moved into the fintech space. So my first fintech startup was straight out of business school, and that was in 2007. Back in the days where the word fintech hadn't really been invented.
Yeah, that was OG. That was before the term fintech was really a thing.
Before we had mobile apps, before we even had like smartphones. Anyway, so that was fairly early doors. And then from there, I actually joined Wonga, and I was the first product manager there. We were very small at the time, about 20 people when I joined, and that business grew to obviously nearly 1,000 people at peak, and obviously now is no more. But my role there was very much on the product side, so I was responsible for all of the kind of product development, developing out our consumer lending platform, developing mobile apps. We then took that principle, which is taking very old-fashioned manual underwriting processes and fully automating them. In fact, we were the first fully end-to-end automated platform at the time, back in about 2010. And we took those principles and launched a similar sort of product, but for SMEs. So taking, again, very old-fashioned manual processes for underwriting loans to SMEs and automating that. And then I also launched a peer-to-peer lending platform for them as well. And then in 2015, I left to start CapitalRise. And my two co-founders are actually property guys by background. And they could see that there was a massive untapped market in the kind of prime property world, to provide prime property finance to borrowers in this specific sector. And they wanted to build a tech platform to do that. And they found me and said, look, we need your expertise. Come and join us. Let's build this business. So that's how I ended up at CapitalRise.
Phenomenal. So let's get into prime property. What's the problem space there? Why surely prime property is fine, it's overserved. Like that you can afford a bit of manual underwriting in prime property, right?
So it's so interesting. So I guess the property finance market as a whole is massively underserved by the traditional lenders. So since the global financial crisis, there have been a lot of regulatory changes that have made a very unattractive asset class for banks to lend to. So to give you an example, traditional banks used to be up to, they filled pretty much 100% of the market up till about 2011. And that has now decreased down to around 75% of the market. So you've got this massive funding gap, which we'll talk in a minute, is even worse and more underserved in the prime property space for reasons I'll cover in a minute. But so there's this massive gap in finance, and that's driven by things such as, for a bank to lend to a property developer, they have to hold 150% of that capital on balance sheet. So for me as a bank to make a loan to you as a developer, and it's a £10 million loan, our loans tend to be rather large, I have to hold 15 million on balance sheet. So 25 million consumed to make a £10 million loan. I'm only earning the interest and making the revenue on the 10. So it's very unattractive. As a result, they've been reducing their allocation to that asset class and increasing allocation to more attractive asset classes for them, like consumer loans or SME loans. So that's one of the key drivers that has created this funding gap. And then in the prime property space, it's sort of exacerbated because it's a very unique and special part of the market with very different dynamics to the rest of the market. And it's very hard to underwrite. You can't treat it. It's not like kind of very vanilla loans, where if you're doing mainstream property market, you can chuck all that into a spreadsheet. You can analyze it, in a very granular way. But the sorts of things we do, we'll get into it in a minute, they're very bespoke, very unique, and you have to be able to put the time into doing the due diligence on those individual opportunities.
It sort of reminds me of the beginning of the story of Oak North. So if you speak to Rishi, who's kind of the CEO and co-founder there, one of the issues they had when they were trying to found their business was they come from a financial markets background and a structured finance background, so they were very familiar with complex risk models, really deeply understanding a very large business and bespoking lending based on the actual risk of that business. But when they were going for an SME loan, what they found was they could only get what the computer said yes or no to. Above a certain score, you get it. Below a certain score, you don't. And it all feels rather arbitrary. And it sounds like, especially because it's very capital intensive, you're getting that in the property development sector here. And I'd love for you to kind of expand on that idea a little bit around, so what were your insights? What did you figure out that you could do once you double click on the spreadsheet and start thinking about risk in a different way?
So for us, it's interesting because if I give you an idea of the sort of assets we lend to, I think it probably give a bit more colour to the sorts of projects, I suppose, that we support. So my loan book is split into kind of 3 different areas. So prime central London, prime outer London, and the prime home counties. So prime central London is where we're talking about Mayfair, Belgravia, Knightsbridge. We did 3 loans in Chelsea in the last couple of months. Obviously quite large transactions if you think about the type of property we're lending to. So our loan size is typically kind of 1 to 10 million, some even more. You're then looking at prime outer London. You're looking at that's when we pick up areas like Hampstead, St John's Wood, Wimbledon, Richmond. You then go into prime home counties. You're looking at areas like Wentworth, Windsor, Ascot, St George's Hill. We recently did a loan in Cobham in Surrey. So really kind of very kind of high-end real estate. I mean, typically we're lending against assets that can be anything from £1 million to £50 million. We have done a loan, this year, which was a single dwelling for 50 million. So they're very, very unique properties, typically in very unique areas, and that means that you have the way that in which you need to analyze that is quite specific. And in our case, it requires a real in-depth knowledge of those locations, in some case really micro location knowledge, to the extent of, well, actually I know that property on that side of the street, that's looking over the Garden Square and Eaton Square, I know it's one of only 8 properties that has its own unique front door. I know that property over there will suffer from tube noise. It's on the wrong end of the street. You know what I mean? It's very, very I think specific. And because our founders and the team we've built have that deep knowledge of these locations, that puts us in a very unique position to analyze those sorts of deals.
So is it primarily residential? Is no commercial or retail or hotels in there?
Yeah, so we will lend to all 4 asset classes. So we will do retail, we will do commercial, we will do the broad range. But I would say the majority of the book is in residential. We have got some commercial on the book as well, but the majority of what we do at the moment is residential.
And then it being alternative lending, what's your source of funding? Is that a little bit different to traditional lenders? It's not traditional balance sheet lending, for instance.
Correct. So we have a range of different sources of capital that we use to make our loans. So we have CapitalRise.com, which is our online platform. So individual investors can come sign up and invest in our loans. The minimum investment size there is £1,000. What's really interesting about our sector is that historically, the only people that ever had access to this type of lending were institutions and ultra high net worths, because the minimum ticket size was in the millions. So what we're doing by building the platform is enabling smaller investors to access an asset class that historically would have been, something they could never have had access to before. In addition to the kind of the platform, we have family offices that invest in our loans, and we have banks that invest in our loans. So it's a range of capital from kind of traditional institutions down to individual investors.
And given, I guess, your specialism, those different investor classes are coming to you for different reasons.
Correct.
What's sort of the makeup there? Are you able to put a percentage on it, or does it really vary? Is it mostly the big banks and institutions, or is it mostly retail? Where does it skew?
At the moment, it's mostly our retail investors on our platform. The vast majority. So they definitely have different reasons to come to us. So I think for the retail investors that come via the platform, it's about the fact they've never had access to this asset class. It offers just to all of our investors very strong risk-adjusted returns. So to give you an example, we've redeemed back out to our investors over 28 million to date, and that average rate of return across all of those loans that have redeemed is 9.5% per annum. And we had no losses or defaults to date. So we're very careful and very prudent about the way that we structure all of our loans. So these guys are getting obviously very strong risk-adjusted returns. They're getting access to a part of the property market that they never had before. We also have an innovative finance ISA, so those returns can be tax-free if you use your ISA wrapper in order to invest. You've got a question? Do you want me to move on to
No. Please continue.
Okay, cool.
There's a question forming in my mind, but there are many. It's an interesting subject. Please continue.
Cool. So that's I guess the individual investors. When you then get to family offices, so family offices have had access to this asset class before, but typically their concentration risk when they used to get involved before is high, right? Because they're putting in a minimum ticket of 1, 2, 3 million into each transaction. So the beauty of investing via us is they can say, well, I want to deploy £2 million, but I want to deploy it across a range of different loans. So they can come in and they can decide to put in 500,000 in each different loan and spread it across a number of loans. So I think the diversification benefit is really important for them, and also the origination benefit. So we have it. Go on.
I was going to say, how does that impact retail? Because if I'm only coming up with £1,000, is there a minimum I can put in? Because that must become an administrative burden for you guys to be spreading that across 10 loans, 20 loans, for instance.
No, so I guess the online platform is obviously fully automated. So there is no admin burden for me, whether I fund £1 million loan with, purely with investors off the platform. If I do it with a mixture of, maybe it's an £8 million loan and I've got £6 million from institutions and I put 2 million on the platform, and that's typically how we do large loans. It's absolutely no problem for me because the digital platform is fully automated. So if I'm raising from one investor, 100 investors, or 1,000 investors, it makes no difference to me.
It made me think that I remember maybe 10 years ago working in the banking industry. There was a frustration that the one property class that seems to always be sort of fine and do well is really well-to-do posh London areas that the retail investor can't get into, and actually this is potentially giving access to that for different people. But you've got a limited supply. Is there a limit on the scale that you guys can go to, and what's the ambition look like?
Yeah, so it's interesting. People think that because it's in terms of the geographic area, it's small, right, compared to the whole of the UK market. But if you think about the actual value of assets in those locations, it's massive because of the high value. These are the highest, most expensive property assets in the UK market. So you'd be surprised. There's billions and billions of pounds worth of loans made in these small areas, niche areas that we focus on. So that makes it very, I guess our unit economics are very good as well as a result, because I can do larger loans. My team are concentrated on a fewer number of loans in terms of loan monitoring. I don't have to send people up on a train to go to Scotland to monitor a site once a month. So it makes it very efficient as well, the fact that we're quite highly concentrated in the kind of southeast of England.
That's pretty interesting balance that you find yourself with. And again, I'm hearing metaphors of Oak North in my head because it's a similar thing. They have these concentrated loans that they're doing in the SME sector that was typically underserved, but they understood those businesses well enough to be able to price risk in there, and then increasingly have been able to automate that. But I just want to remind everybody watching, do keep sending in your questions. We will get to those with Uma shortly. So if you're watching, send us your questions and we'll absolutely get to them. Can you believe we're almost halfway through already? In fact, just past halfway through. I'm having a great time talking, so they're going to have to be good questions, people. So I'm going to flip to the risk side of the equation. What are the risks here? So for retail investors, how are you keeping people safe? Because automated lending is great until it goes wrong.
So from our perspective, our loans are structured in a very we do in very, very intense DD on all the loans that we put out there. We're incredibly selective. So just to give you an example, we screened £3.4 billion worth of loans last year. And that's huge amount. You're talking about the target size, the market size. It's a huge market, but we're very, very discriminating over the deals that we choose to fund. And within that, we then structure it very carefully. So to give you an example, when we look at a loan, we will stress test it. We'll look very carefully at what happens. Typically, things that can go wrong in development project. It can go over budget. It can take longer than you think. It might sell for a price. The property might sell for a price that's not what you hoped. So we will stress all of those dimensions, to a very extreme level. So I'll look at, what does this loan look like if it's 12 months overdue, if it's 18 months overdue, if it's 24 months overdue? What does this look like if, I don't get the developer doesn't get what he hopes, but he's going to get 15% less, 5, 10, 15. What happens if the construction costs are, 10, 15, 20% more? And if all of those things happen, I look at my position, and if I'm still in a position where I'm not suffering a capital loss, then I'll be like, okay, fine. That's something that we will happily put forward and consider in more detail. So we do a very conservative lending. Our average loan to value across the whole book is 62%. So what that means is, I need for the property eventually, I would like for the property eventually to sell at, its target value. That V in the value is a red book valuation that we've got from an independent third party, the likes of Savills, Knight Frank, etc. That's what I'm lending against, but I only need it to sell for 62% of its value for all of my investors and all my return to be paid in full. So that's 38% headroom on average. So that provides a massive buffer, to tolerate, the costs being slightly greater than planned, the sales price not being achieved and us achieving something somewhat less. Even with COVID-19, we're looking at all of our loan book on a regular basis, and we don't see any significant stress, in our books such that it would, use up more than the contingencies and the buffers that we've allowed. And that's because we've structured it very carefully. The worst case scenario, coming back to the risk, is we get to the end of the loan, the borrower is unable to repay. We then have security over the underlying asset. We would then force the sale of that security in order to repay investors. And what I need to do is recover, on average, 62% of its value at exit in order for everyone to be okay. We've never had that situation occur, but we have the comfort of knowing we have all those protections in place, such that if that scenario did occur, we're able to, to do that.
It's phenomenal, the level of human touch that seems to be involved. So on the one hand, whilst the buying from the investor side is fully automated, the human touch on the other side seems quite significant. You say your unit economics are strong, but it also appears to be that having the right humans is really, really key. And how have you found that sort of hiring process, and how's that going to help you scale?
Yes, this is a really good point. So it's probably worth talking about the founders. So my fellow two co-founders have been in the prime property space for the last 20 years as property developers themselves. So they've done over 120 projects, without any losses over the last 2 decades. That's 3 property cycles that they have survived. Very well, done very well out of it. And so that knowledge that they have, and that micro knowledge, because all they've ever done is prime and super prime real estate development. They've delivered over £2 billion worth of real estate development. They've got 1 billion under construction. So they really have very deep expertise in the areas that we focus on. They are on credit committee and they screen every single opportunity. And like me as founders, we put our own personal money into every single deal that we do. And I think that's a very important gesture to our investors, to say we would never put anything forward that we would not personally or aren't personally investing in ourselves. What we have done is I have then built a team around them who have got expertise, because a lot of people that have come from the banking world will have done, as real estate lenders, they will have had some experience in prime. They won't have been doing it 100%, but they will have done some of it alongside serving the mainstream market. So I've brought those people in. They've got really deep, 20 plus years experience lending from within a banking environment across the broader market. And then, we've developed that in-house knowledge and been able to disseminate some of that knowledge such that now, I guess our processes and the checks that we do and so on are sort of have taken that knowledge from the founders and disseminated it into kind of, this is the CapitalRise way of looking at our investment opportunities.
A really interesting model of sort of building around the founders and almost, I don't want to say milking them, but it's kind of taking
that knowledge out.
Yeah, spreading it out. Some
Yeah.
questions coming in. First one here from Sajid, who asks, any plans to go for an ecosystem play to increase the product portfolio to specialized insurance or specialized house maintenance? Is that something you've considered?
I think at the moment, not yet. I think for us, the target market that we could address with our current model is huge, and we
Mhm.
are still an absolute drop in the ocean. So for me, the focus is on carrying on doing what we're doing, continuing to scale. And I
Mhm.
think once we've got, I mean, the other thing that's quite interesting for us is that London real estate, London is one of the biggest global real estate capitals in the world. So people often say, "Oh, you're going to move into other countries? Would you move outside of, prime central London? You do a lot of that. Would you move into other parts of the UK, etc." I mean, we've got a lot that we can still do within the remits of the area that we focus on. So for me, it's about smashing it out of the park, continuing to scale, and then starting to think about where we go next. And likelihood, to be honest, for us is that we'd move to another global center
Mhm.
with very similar dynamics. So yeah,
Yeah,
CapitalRise
major
is,
global financial center, New York, for instance, something like that.
exactly, yeah, exactly.
Yeah,
Another global capital real estate market.
it's super interesting to watch. There's a question from Ray Wong who asks, have the end user requirements for PCL property changed since COVID, e.g., air filters, or is it too early to tell?
Yeah, so it's interesting. So we obviously speak a lot with the with Savills and like Frank and the guys that are very kind of, I guess, market commentators and experts in our space. And I think it's a bit early to say that we've seen those trends, but I think it's very clear that some indications are already coming through in terms of what people are searching for.
Mhm.
And I think you can see it's the same trends everywhere, right? So you're getting people that are looking to prioritize outside space more, people prioritizing the ability to have a home office,
Mm.
people assuming that remote working is going to be probably a long-term part of, to some extent, their lifestyle. People looking for a pied-à-terre close to their office because they might have, live outside and want to go for that big house out in, the prime home counties, but then have a little bolt hole in the city for those 1 or 2 days a week they come in to use that as their base. People prioritizing living closer to their offices is another trend that they're seeing. So you can be within walking distance or cycling distance and not have to take public transport.
Mm.
But yeah, excuse me, there are definitely some trends that they're starting to see, which I think is a result of us all having been locked in our own homes. I mean, you locked in your own home for 4 months, it really makes you kind of reflect on the quality of your accommodation, and is it really, are you loving where you are, or maybe do you want to make a change? So I can see that I think the next year will be very much affected by changes in buyer behavior.
And that's going to be super interesting to watch. I guess it's such interesting times for the property market generally, and at all ends of the spectrum, it's kind of throwing question marks in the air. So it's interesting what you're seeing. But what about the investor side?
Mhm.
Since you've opened up, how has investor appetite been? Are they looking for things to be more liquid, and how liquid are the investments on your platform? Because I guess what's the appetite like, and how liquid are you seeing demand and opportunity?
Mm. So, I mean, our average investment is 17 months in duration. So when somebody invests in a loan on our platform, the typically all of the income and the return will come at the end of the project when the properties. So typically a developer is buying a property, they're going to do it up and they're going to sell it. And when they sell it at the end, that's when the loan gets repaid and all of our investors will get their return. So 17 months is the kind of average term. Most of our investors will keep their, make the investment and keep the funds in for the 17 months, knowing that that's when they expect to see their return come back. We do have a secondary market. So if you do want to exit early, you can do so. Obviously, it's reliant on somebody else coming in and buying that investment off you. It's not very heavily used because most of our investors come in because they want to have that full return and get their money back in 17 months. And they already mentally decided that they're happy for that money. They don't need it right now to be put away and to be earning them that return. So we have a secondary market. When things go on there, they get picked up. It's been equally liquid since coronavirus as it was
Mm.
before. I know some platforms have had to stop, block their secondary markets. They've taken them down. They've been flooded with people wanting to take money off the platform and haven't been able to. It hasn't been liquid enough to do that. We did not have to do that. It's anything that went up there got bought. So we have. I think it's quite. I suppose it's quite exclusive what we offer. and we've tended to be very had have a real strength of demand. Some of our loans, I mean, to give you an example, during the lockdown period, we did a loan which was we raised 2 million in 2 hours.
Wow.
And the majority of our investments tend to be oversubscribed. We have a really strong customer base that loves what we do. And if anything, the balance is that there isn't sufficient product to serve the demand that we see.
Well, and that was going to be my question, because I mean, can you believe we've got 3 minutes left and the time has just absolutely flown by?
Yeah.
But I was going to ask, what's next for CapitalRise? Because I know you mentioned looking at other markets, but can you possibly provide supply fast enough, or actually is the lack of supply just intrinsic to the nature of the market you're serving?
So for us, really, for me, the focus is on obviously delivering more, very high quality loans to the market. We are incredibly fussy, so that is something that we need, because we want to keep our perfect track record. So we don't want a loan to not perform. So we will always be very cautious. But the market is there. There's huge amount of demand. For me, it's about ramping up my lending team and using as much automation as possible to streamline those processes. So you talked about kind of manual versus automation on the lending side. We have built a new portal recently. So it's really kind of the knowledge and the expertise is the bit that I need the humans for. But there's a lot of other dross that happens, a lot of kind of administration. It's quite a complex process closing a loan. You've got valuers involved, you've got lawyers involved, multiple sets of lawyers, you've got a lot of documentation. The legal docs themselves, on a particular loan, sometimes can be 300 pages worth of documents. So you've got to, that process needs streamlining, and that's where we focus the technology effort. And that will help us, both the team growth and the technology, enhancing our tech there to do more loans and bring more loans on stream faster.
I'm interested. Oak North have gotten into a position where they built a unique risk model, and now they're sort of selling the risk model as a platform. Is there a potential for that, or is that too many years away to think?
I think for us, because we are so specialist, what we do is really very targeted and tailored to the sorts of areas that we focus on. I don't think there would be really mass market appeal for it.
Interesting.
And it doesn't translate, what we do doesn't really translate to the mass market.
Fantastic. Well, listen, that is the top of the hour. Can you believe how well that's
I can't believe that's
flown by?
so fast.
I know, it really did go way too fast. I'm enjoying myself, and I'm sure you've all got days to get to, though. And so thank you for joining me, Uma. Where can people find out more about you and what you're getting up to at CapitalRise?
So you can come follow us on social media. CapitalRise.com is our website, but we're on LinkedIn, Twitter, Facebook. You'll find us everywhere.
Everywhere. I will look out for you everywhere. That's all we have time for today. I'm sure you got lots to get to. Tomorrow I will be joined by Paul Harold, who is from Curve at 8:30 a.m. BST. Do not miss that episode, people. Have a great day, everybody, and see you soon. Goodbye.
Thanks so much.